All right, welcome back to Bullish. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Episode number 7. Thanks for listening in. We've got a great list of companies that we're going to be covering today. Some really interesting ones. We're going to be looking at UBS, Dell, UiPath, Dave & Buster's, Toro Company, DocuSign, Adobe, Restoration Hardware, Kroger, Oracle, Casey's General Store, great pizza, maybe not, Lennar, GameStop, Smith & Wesson. Remember, anything talked about, the stocks we talk about, this should not be taken as advice. Past performance, not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nicholas, it's Friday. I tried to bring a little bit more energy than I had last week. How'd I do?
Wow. Just unbelievable. I cannot believe where this entered. Did you have an extra cup of coffee this afternoon? That was unbelievable.
It's called I haven't had lunch yet and one too many cups of coffee and didn't get enough sleep last night. So I'm all over the place, but feeling great.
And no more, maybe COVID. You might have had COVID. Is that true?
No.
Oh, okay.
What is that? Never heard of it. I don't know. We'll see. I got 2 young kids, so there's as you know, there's something new coming in the house every week. Abel started preschool. 2 days a week, couple hours. So who knows what kind of, cesspools being passed around over there. It's just part of it,
Oh, yeah. Absolutely. Just not to take your word away from you, but absolutely.
I love that word. Absolutely. Absolutely. All right, let's get into it. UBS, top line. They were in line with top line estimates, handily beat the bottom line, total revenue over $33 billion this year. If you look at what was growing, banking revenue was up the most, wealth management for them basically flat. Asset management revenue was way down, investment banking way down. I know kind of investment banking across the board's been struggling, but the big thing to talk about with them is this merger with Credit Suisse obviously came out of nowhere at the beginning of the year here. I know they booked a $29 billion $29 billion, there in revenue from the deal that was recognized this quarter. Obviously, still a lot of work to do left to integrate that, and a lot of risk, underperforming assets that kind of come along with that. But I mean, they scooped it up at a steal. I think it was $3.25 billion is finally what it ended up at as far as the price tag on the deal there. So stock, as of yesterday, was up about 3.5% since the earnings.
Yeah, not to talk badly about these guys, but without the Credit Suisse thing, this is a terrible disaster of a company. UBS has had so many problems. One of the worst wires out there. I think we can agree on that. Other than Wells is like bottom of the barrel. It's like the Titanic at Wells. People cannot leave fast enough. So UBS was not far behind it. There was one point where Morgan was going to buy UBS's wealth business because it was such a disaster. But so far hasn't happened. This is what saved them, the Credit Suisse thing. You saw this short-term pop with J.P. Morgan buying First Republic and getting the assets there for pennies on the dollar. Well, I hate to say it, but I don't overly respect it when these companies come in and take advantage of people, and then they take credit for somebody else's misfortune, which whatever, I guess they manage better than Credit Suisse. That's why they're still standing. But I don't know. As an investment, I think long run you're going to get back to those low growth rates. These European banks are an absolute disaster. And I know, the Swiss banks are a little different than the other European banks, but without this acquisition, it would be basically meaningless.
Well, clearly some issues over there too. Otherwise, Credit Suisse wouldn't have been in the position that they were in the first place. Dell crushed top and bottom line estimates. Revenue was down 13% year over year, shared by both their infrastructure and client solution group. We had earnings per share down a little north of 7% there. But, I saw a report, one of Wall Street's biggest banks out there singing Dell's praises, mentioned it as an early winner of this generative AI adoption. For those who don't know, obviously generative AI is kind of the AI capable of generating text, images, other media, things like that. Their AI servers now increased about 20% of their mix. So stocks up, over 27%. I haven't looked this morning. I know the market's getting hammered a little bit, but their year-to-date return was north of 70% already.
Yeah, it's insane. I don't know what we were doing. I guess we were sleeping on this one, but man, they've had a nice year, nice 5 years too. Sometimes you look at these things and it's up like 70% for the year because it went down 70% last year, but that's not the case at all. These guys have actually had a nice run. Now, I will say 5 years ago, stock was $27 a share. In March of this year, so March of 2023, it was 37 a share. So most of that return, you just have to, from a data standpoint, just be aware of this. Most of that return came since March, the past 6 months. And without that, we'd probably be at a total return the past 5 years of about 45%. Nothing to write home about. It's been the return the past 6 months that's really driven this thing forward. So we haven't owned it because of that. Now, should we have? Yeah, obviously it's done well. I don't know enough about it to know if it's going to keep doing well, but these are the types of things as an investor. I think this is a good lesson. This really paints a nice picture for investors as far as, like we always say, you got to stay invested across the cycle. If you're going to buy a stock and you're going to own something for the long run, or at least say you're going to own it for the long run, you got to be a buy and hold. You can't, say you're going to buy it and then sell it immediately at the first sign of trouble. And that's been proven true here. Most of the return, again, past 6 months, if you sold early, you would be sitting at a 40%, maybe 45% return the past 5 years. With this little jump here the past 6 months, you're up 157. So kudos to you if you held it. Nice job.
All right, UiPath, robotic process automation tool there, pretty much on par with top line revenue, really excelled when it came to the bottom line. Revenue was up 18% with annual recurring revenue up 25%. In working with, I have no idea what happened there. That was the coffee. Working with a lot of big players really can quickly scale large customers. So we're looking at big names like Microsoft, OpenAI, AWS, Google Cloud. Earnings per share, they killed it, up 15%. Stocks up 10% since the earnings came out here.
Okay, UiPath, I just sold it. I owned it at the wrong price, took an absolute bath on it. I do like the story long term with RPA. One of the problems, though, I think with UiPath is there's a lot of competition. They're doing about, I think, $1.3 billion in annual run rate. And, it's pretty good. But the problem is Microsoft already has its own RPA business. They're like directly integrated. And anytime you log into your 365 account, they're like, hey, do you want to try RPA? So that's one of the problems. And this is where you look at, and I know people make that argument. I would equate this to that argument about Zoom versus Teams. We use Teams at our company. I used Zoom previously. Obviously, Zoom is a little bit more integrated. Teams is not. There's been complaints that Teams is no good. I don't know what your thoughts are. I don't have a problem with it. Do you?
No, I mean, Teams is fine. With a smaller company like we have at the moment, it's really easy, and I think integrates well. We only do so many virtual calls. So, I mean, Zoom was fine, but it had its issues. What was the one before Zoom that everybody loved? It was kind of the
like Cisco WebEx.
Yeah, WebEx. WebEx was terrible.
Oh, WebEx is terrible now. Bottom of the barrel.
Yeah, but I don't mind Teams. Every once in a while, it gives me some issues, but I'm not going to complain about it.
So this is one of the things I think with software. This is just a structural thing. Is the fact that when you have the platform and the scale, what are these companies going to do? They're going to sell you more stuff. They already have the customers. So to break into a tech stack is already hard to begin with. That's my problem with UiPath. Now, obviously, they've broken into a lot of tech stacks. Okay, they've proven the business model works. I'm just worried that longer term, Microsoft is just going to replace them because they're already there, and it's like, all right, we're not going to charge you a whole lot extra for RPA. It's just going to be part of 365 or something, and then maybe your monthly total goes up. So that's my only concern. I totally agree with the business model. I mean, RPA is obviously the easiest AI push you can get into. And when people talk about AI, we talked about this with NVIDIA, we talked about this with a number of companies where they're like, oh, we're adopting AI because it's the hot buzzword. All they're doing is RPA. RPA has been around for 10 years. It's nothing new. So, I don't know. UiPath, I get it. I understand it. Lost a bunch of money on it, so I'm not happy about that. But not for clients. I will add that we never bought it for clients. Lost money for myself. But I don't know. I think they ultimately it could be tough fighting an uphill battle with Enterprise.
Well, glad you can admit that. Let's jump over to a very different business, Dave & Buster's entertainment spot everyone knows and loves. Missed across the board. You know, revenue increase of over 15%. Earnings per share was basically flat. But I will say, as I look through these, I love reading some of the cherry pick stats. They're talking about comparable store sales were down 6.3% from 2022 last year when things had basically returned to normal. All of a sudden, I'm looking up, but they're up 5.8% compared to 2019. So you're telling me we're looking at comparable, you just cherry picked 4 years ago, like the last 3 years didn't happen, and like last year wasn't a disaster. Anyways, stock bounced back a little bit. You know, it's down north of like 3.5% since the earnings came out.
Oh yeah. Dave & Buster's. Look, great place to have a good time. I haven't been in years. I went, I don't know, 7-8 years ago now, and man, the stock's gotten whacked. They are a value. It's a value trade or a value trap. You'll have to find out for yourself. I will not be finding out with you. I would never buy this stock in a million years. Never say never. I don't know. Is Dave & Buster's getting into AI? If they're getting into AI, maybe we'd be interested. But
I doubt it.
Okay, here's the thing, Sam. Every show, we like to rip a company to shreds. Sorry, Dave & Buster's. You're the company this week, going to zero. I'm just making the call. None of this show, by the way, is investment advice. Don't do anything that we're saying. But all that being said, this is the one this week I think is going to zero. And maybe we start a segment, Sam, just as an idea. We do a going to zero and we do a going to the moon, as our intern Zach would say. So I don't know. Dave & Buster's, they're not a moon stock for me.
No, well, there's so many, companies that have come out since then. Main Event. Think about all these cool places that have the virtual reality built in, where you go into a room with a bunch of people and can play games far beyond what Dave & Buster's had. I mean, as a kid, it's fun going and playing the games, spending your parents' money, and calling it a day, taking your tickets in and getting something dumb. Like I had a switchblade comb back in the day that I got from a Dave & Buster's. Dumb, total waste of time and my parents' money, but it's fun for 4 hours on the weekend.
Yeah. This thing is long run. It's a disaster. I mean, they only have 150 locations in the U.S. It's tiny. It's a 1 point. I'm not to rip you, Sam, on this one, but $1.5 billion in market cap. Not sure why we're covering it, but here we are. It was fun.
Well,
I guess
people. Yeah, people know. We'll never cover it again. Don't worry, people. We don't want to waste your time. Don't go to Dave & Buster's. It's going to zero, according to Nick.
No,
unless you're
there. Be a customer. This is one of those ones. Be a customer. Have a good time. Put your money in it? No, you'd be out of your mind. A 5% net profit margin? Are you crazy?
All right, Toro Company. Tough quarter. Also missed estimates across the board. We're looking at revenue down 7%. Now, if you really look at what that kind of came from, very poor residential sales for them, down almost 35% here. Obviously translated negatively to the bottom line for them. They were down, net income down 112%, I think I saw. So, I mean, not surprisingly, obviously residential sales being lower is no surprise, something that we've been seeing across the board in a number of business lines. But professionals, I think it was up 1% I saw. So professionals still going towards them, like in the equipment that they have, but stock's down about 16% since the release.
Did you know, I could be wrong, but did you know these guys are the same as the Ditch Witch? Did you know that?
Is that the one that like just digs the ditches like there's nothing there?
Yes, they make ditches. That's it's in the name, believe it or not. The Ditch Witch.
Wow.
Yeah.
Lucky guess, I guess.
Yeah, that's exactly right. Now, here's the question about Toro. We don't own it, but here's the big question. Did they possibly get caught up in the COVID cash era? Now, I did just have a client tell me they bought a newer house with a big yard. I'm talking a couple acres. They spent $3,000 on one of these riding mowers. Seems like a lot. I don't know. I have a little push Toro mower. I do know that they are the gold standard of mowers. But my only concern here is I think they got caught up in the COVID cash where people had money to spend. They're buying houses, then they're getting these Toros. They're spending more money than they probably should have. That's probably why it's off its all-time high. My feeling here is there's probably more downside back to those 2020 levels, similar to what we've seen with Traeger grills, similar to what we've seen, maybe not as bad as Peloton, because at least they have a real business, like unlike Peloton, the disaster of a company that is. So maybe at some point it becomes a buy. I just think right now it's probably still a little bit rich.
Yeah, well, and some of those, I mean, if you take care of those riding lawnmowers, they can last for a really long time. Like my parents, when they bought the house that they're in now 12 years ago, the guy before had bought one of the riding lawnmowers because it's like a couple acres, the lot. And my dad still uses the thing now. He's had to put some money into it here or there, but I mean, that thing's probably 15 years old at this point. So they last for a while.
You can't argue with the long-term stock price. I just think probably going forward, the growth is somewhat limited. I still think there's a little, like I said, a little downside from the COVID era, but at some point it might be a buy. The forward P is 27, the current's 23. Not what you love to see when you're going out to buy a stock. So something to keep an eye on the watch list, but not something we're going to buy right this second.
Okay, DocuSign. Now, this was actually the one that I had on for the biggest loser from its highs for the show. Now, do I think it's going to zero? No, but it's down 85% coming off COVID highs there. Obviously, nobody was in person, so they were using the business. But, I mean, revenue was still up 10.5% year over year. Net income up 100%. Big partnerships with very well-known companies, Salesforce, Microsoft, Workday, all the biggest names have some type of integration that can use them. I mean, I know we use it in our business. Could you imagine if, we were getting wet signatures for all the documentation? It'd be a nightmare, but stock continues to struggle. Obviously, other players in the space now, Adobe, which we're talking about next, being one of them, stock's down 15%, so.
Yeah. Okay. So DocuSign, I made money as a trade on it, believe it or not, during COVID. Thank God I got out of it, and that was just pure luck. So can't attest anything to skill there. That was just purely timing. DocuSign is definitely a value stock right now, but it's a question of how much more of a value it becomes. You have to remember, okay, 2020 price to sales ratio, Sam, price to sales, 31.5. 31.5. If you bought it for 31.5, you're absolutely nuts. Look at it now. But now, okay, it's actually profitable. Price to forward earnings is 20. That's looking pretty good. I think you're right, though. I think there's a lot of competition. There's a lot of places. One of the things I heard, and the reason I wouldn't buy DocuSign for the long run, is I have heard through the grapevine various places are coming up with their own internal signature process that's not even a DocuSign. It's easier than a DocuSign. It doesn't involve documents. It's literally just like they look at your eyeball or something, and that's how you sign. That's my concern, is not enough, really protective business things there where it would, be a long-term buy. I don't think they have enough of a moat to protect their earnings.
Let me ask you this. If somebody said, here, sign this document, but you have to do a retinal scan, would you want to do that?
Well, not me personally, but there's a lot of people out there, if they start doing implanted chips, they're going to sign up for it. So now, am I a chip guy myself? No, I will never get chipped. You can't chip me. There's people who are going to do it. So that's my point. I think a lot of places, they're just going to directly integrate.
Yeah, we can't even open that can of worms. That'd be a long conversation. Let's do Adobe here. Top line, bottom line estimates by a little bit, just beat them. Revenue was just shy of $5 billion, which was a 10% increase year over year. Every business segment saw solid growth. Subscription growth was up 12%. I know they're feeling confident moving forward. Additional creative possibilities that AI is kind of bringing to their product portfolio. I've messed around a little bit because I have whatever the subscription is for some of the documents that we got to deal with, but I haven't looked too hard into it, if I'm being honest. They have had a strong year. It is down 4.5% today, following their earnings because they just came out yesterday. But from what I've read, seems like maybe the market was looking for a little bit stronger guidance coming out of this AI bump, and maybe they're just pulling it back a little bit. They didn't, exceed expectations as much as they should for the price that it's trading at now.
Yeah. This is one where it's just a valuation story. I have nothing bad to say about the business model. Actually, I really like the business model. These guys were so smart. They pivoted everything towards a subscription basis. I think you can still buy one-off products from them, but that was the genius of the strategy. And their management team has just been so smart about how they've run this thing. And they pivoted towards a subscription model where you have access to all these different products, like Photoshop and Lightroom or whatever it is. Premiere is the one we use for editing, all these different, services. And then they pivoted away from just you buy one as a standalone one time towards now you're paying, I think it's like $40 a month is our subscription. So that was that was brilliant. That was genius. It's just, 47 times earnings. That's a little rich, man. I get a little nervous on something like that. We had it in the portfolio for a while, made some money on it, but now you're sitting at a forward P of 48, 49. Boy, they really have to perform to get to justify that. So that's my only concern there. That's why I'm not buying it, but not because it's a bad business. It's a great business. Just to me at this point, the wrong price.
Yeah, if we were talking end of 2022, when it was down 60% from its highs, it may be a different conversation. But let's jump to Restoration Hardware. Beat top and bottom line estimates, but overall saw decreases in revenue, down 20%, earnings per share down 26%. Another one where they totally lowered estimates and beat them, but people aren't dumb. They see what's happening. It's been hit hard like other luxury, home furniture stores. We talked Williams-Sonoma, which is Pottery Barn and West Elm, a couple weeks ago now. Saw the same thing with them. Things should remain slow here as the housing market slowed down a little bit, at least into next year is kind of what they were talking through. So they were actually having a decent year, but they've dropped 17% since the earnings release.
Yeah, Restoration Hardware, really neat company. It's upscale. Okay, that's the word they use to describe themselves. Upscale, luxury, whatever. But it's not the most premium. So they fall in that nice little kind of mass affluent bucket. Obviously, a really well-managed company, really neat stock. But, one of the problems, and that's with all these companies, is you're trying to figure out how much did the COVID cash really play into this? And I kind of alluded to this when we talked Williams-Sonoma a couple episodes ago, whenever it was. And look, not a bad business model, great company. The bigger question, though, is like how much of those sales are durable? And when you move up market too high, you could be at risk of potentially not having enough operating leverage and then getting hit pretty hard when there is a small downturn. So that's why I'm a little cautious on it. I know a PM that really smart guy who bought this thing and timed it really well, but again, it's in this downward spiral. It peaked at 401 a share. So if you bought it in April of 23 and you paid $232 for it, you doubled your money by August. Great job. For most of us, though, we didn't do that. Good chance this thing does kind of retest some of those lows before it goes back up. Then I'd definitely be interested in it. I just don't want to overpay for some of these things. I think a lot of people say, Restoration Hardware, Pottery Barn, West Elm, Williams-Sonoma, all that's tied to the housing market. Yeah, I get that. I understand the conventional wisdom there. But I do think it's more so tied to how much cash people have in excess. It's not just the housing market. So if people have money, if they have excess savings and they're going to spend it, then you're in a good spot with Restoration Hardware. So I think that's the more important metric rather than housing. So that's what I'm watching. That's where I'm a little cautious. I do think people are sort of using up some of that excess cash, and that could slow down sales at some of these places.
Well, and if you stretch to buy a house too, you forget about how much furniture costs. I mean, even if you don't buy restorations hardware stuff, it's a big purchase. People buy a house and then all of a sudden they're filling a room, they're filling one room a month, stuff like that. So just something to keep in mind. Let's do Kroger. Barely missed top and bottom line. Barely missed on the top line, beat bottom line estimates, there. Revenue down about 2.25%. Their net income was actually negative this year, about 180 million, which was a substantial decrease. But there's really two big topics of conversation to cover with Kroger. Number one is they have an opioid settlement that they structured into as a loss this quarter. The total payout there is going to be like 1.5 billion, 1.4 billion, something like that. And then they're merging with Albertsons, which they're two of the top five largest supermarket retailers in the U.S. So they're going to be at almost 5,000 stores nationwide. And I read a little bit on that deal. The government, is getting involved a little bit because they're worried about them having monopolistic pricing power to some extent. So I think they may have to divest some of those stores. We'll wait and see what happens. But stocks, they're massive. Stocks just kind of stayed flat since the release here.
Yeah. So are these the guys who own Mariano's as well?
I don't know if they have them in their portfolio. Let's see here.
I look that up, but I think they do own Mariano's, which is a nice spot. I actually really like the long-term story on these grocery stocks. They do? Okay. And then Albertsons, they're going to merge with. Is that expected to close? Do you know when that closes roughly?
I didn't see anything on when the expected close date is. I think they've got to do some things to appease the U.S. government before, because they've been in talks since middle of last year, I think.
By the way, how in the world did these guys get entangled so badly with the opioid crisis? Is it because of the pharmacy? Is that what it was?
Yeah, the pharmacy.
But why would they be in trouble for that?
I don't know. I'll be honest. I didn't read through the entire article. All I know is that they're on the hook for 1.4 billion. I think part of it is they out of the their good graces, they're trying to kind of smooth things over with some of the communities affected by it.
Yeah, I get it. Okay, look, no, I totally sympathize here, and what Purdue did and all these companies, they definitely deserve to pay. I watched that documentary. I don't know if you watched that one with on Netflix, Pain something or not. It was really good. You got to watch it if you haven't. But obviously, there's a lot of people that deserve to pay. These guys, though, it is kind of surprising. $1.4 billion over the next 11 years. And then it says that the government's also going after Express Scripts, OptumRx. That is sort of shocking. Publix, Albertsons, they're all paying. But whatever, I think the long-term story in these grocery chains is pretty good. We talked about this yesterday. It is very sensitive. So if there's a small little, error, or there's something little that happens, it can completely mess up the net income. But one of the good things is I think this Albertsons deal was genius. I think that was really smart. And I think you have to do stuff like that, right? You have to be able to scale, and that was a good move on the management part. I'm not buying it yet. We don't own it, but I do like the idea of it. It's a pretty interesting company.
Okay, Oracle pretty much in line with estimates across the board there. Revenue was up 9%. I know the CEO mentioned that their cloud infrastructure was up 66% this past quarter. Earnings per share was up 53%. Obviously, big push forward for them is it's another AI. They've got their remote direct memory access is their big thing. It's interconnected with NVIDIA's supercluster chips, can supposedly train AI models twice as fast for half the price. I don't know. Like a sales pitch in there from, is it Larry Ellison that started Oracle? Was talking about that. So stock's taking a little bit of a dive. It's down 10% since the earnings. I know I read an article, one of JP Morgan's top analysts who covers them had downgraded it from a buy to a hold, actually, following estimates. So there might be some bumps in the road for them as they try and kind of expand into this. Maybe they didn't have all the infrastructure in place like we saw with NVIDIA, who was just ready to go. They just, the coach needed to give them the call up.
Yeah, people act like I guess this is a tech stock, right? We could call it that. One of the things is it's still up 36% for the year. And that's what drives me crazy about when these things sell off 10, 12%, everybody panics. They're like, oh, it's down 12%. It's like, yeah, it's still up 36% for the year. It's up 62% the past 12 months, okay? Put things in perspective when you buy these. It's up 122% the past 5 years. If you're going to buy something like Oracle, you just got to use common sense and not panic. I just can't stand that when people panic on these things and they go, "Oh, it's like Oracle's down for the day." It's like, yeah, it's a tech company. It's going to be down once in a while. It's a $312 billion market cap. So just go in eyes wide open. We have a small position in our portfolio for it, and I think long term it's fine. One of the things that's going to happen is they have to kind of reinvent themselves. There's a lot of mid caps and like SMBs that use Oracle's old infrastructure, and I have talked to tech consultants and they're like, it is a problem. Some of their stuff is old and out of date, so they're going to have to reinvent themselves. I think they're slowly doing that. They're slowly getting more cloud based, so that's going to help them long term. But these guys are just an absolute massive gorilla. They're the 800-pound gorilla, and usually those are the guys who figure it out.
Yeah, I mean, their market cap's over $300 billion.
Yep.
So, Casey's General Stores missed top line, hit bottom line estimates. Big reason for that being inside store sales up 8%, with margins also increasing slightly for them. So, multiple articles, maybe a tweet or two talking about pizza being a large proponent of the sales growth, a big part of that inside sales. I will say, pizza expert, self-proclaimed or not, Dave Portnoy was saying it was highly unlikely. Not a fan of the pizza. I actually did a little digging into what he had rated it back in the day. A few years ago, he rated it a 5.2, the breakfast pizza, which I know is like the big thing everybody raves about. I haven't had it in a while, so maybe I need to try it again. Tried it again last year, down to 4.9. So I don't know. I mean, all jokes aside, Street kind of likes it here. Stock's up almost 17%. I know they've continued to see steady growth. Store counts over 2,500 at this point. They added 15 net new stores last quarter. So
this is a really dumb question. What is a general store?
Couldn't tell you. I mean, they've got, I don't know, you walk in there, they've got food, drinks, the normal stuff you see, the prepackaged stuff from gas stations. Maybe they got, some hot dogs on the spit, some taquitos that have been rolling around since 6 a.m. that morning. I mean, that's the kind of stuff. I will say I've had them. I haven't felt great the next day. Their breakfast pizza is a big deal. And then they've got some, cleaning supplies, stuff for your car if you need it. All these gas stations are turning into these massive things now. Their footprints are huge.
What is the difference between this and any other gas station, though? Is there a difference? Or like Walgreens, you can get anything you need. That's in every town and every state.
Yeah, I don't know. I don't know what to tell you. They're more rural. That's usually where I've seen them. There is one going in over by my parents' house out in the suburbs here. So, massive gas stations. People are bullish on massive gas stations where you can walk in there and I don't know. Think about Buc-ee's. All you hear about is Buc-ee's. Oh, you go somewhere, you got to go to Buc-ee's. But that's like a warehouse, isn't it? It's like Costco with gas.
Well, here you go. Okay, general stores and itinerant peddlers dominated in rural America until the coming of the automobile after 1910. Farmers and ranchers depended on general stores that had a limited stock and slow turnover. They made enough profit to stay in operation by selling at high prices. Often farmers would barter butter, cheese, eggs, vegetables, or other foods, which the merchant would also resell. In the South, the general store was important after the Civil Wars. The merchant was one of the few sources of credit available. Oh, interesting. Until the cash crops came in. So they were almost like banks. They offered credit for farmers. That's really interesting. I didn't know that. But I doubt Casey's is doing that now. Casey's is more, it's just in the name, right? It's just, hey, we sell gas and stuff. We're a gas station. That's what it is, right?
Yeah. Anyone that I've been to is just like another gas station. Just so happened it was on the right side of the road for me. And set me up for success getting back onto the highway.
And why does Wall Street love this so much?
I couldn't tell you. I mean, their sales are up. Maybe they haven't been as reliant on, I don't know, the food. Like,
fun fact,
a lot of places, sell a lot of cigarettes and stuff. As we see, discretionary spending come down. People aren't going into gas stations as much buying stuff. They're still going to Casey's maybe, and clearly they've seen great growth.
Fun fact, they do sell taco pizzas.
Yeah, I don't know. I think the thing is they do have pizza in there. Like, that's one of the differentiators. You can buy a fresh pizza. Now, whether it's good or not is up to you to determine. I doubt I've never had a good taco pizza. I'll be honest. If somebody wants to send me an email and say, hey, this is the best taco pizza I've ever had in my life, you have to try it. You're looking a little thin, which nobody's saying that these days. sam.hardy@StengerFamilyOffice.com. Shoot me a quick email. I would love to try it.
The idea here basically is this is a 7-Eleven competitor. That's what it is. But it's done very well. It's up 117%. It's basically performed like a tech stock the past 5 years. That's unbelievable. Kudos to these guys. Great job. They knocked it out of the park, and we'll do one of these little deals. Wait a second. There you go. Congratulations, Casey.
We don't necessarily know why, but keep it up, I guess.
Whatever you're doing, don't stop it.
Yeah. Let's. I'll use my favorite word. Absolutely. Don't stop, Casey's. I will be having a breakfast pizza soon. Maybe once this one is finished over here near Roosevelt, I'll bring one in for us, and we can do a little taste test in the morning. But let's jump to Lennar here. Interesting one for the housing markets for us. Obviously, big home construction company based down in Florida there near Miami. Beat across the board. Showed actually there's a lot of strength in the new build market. Obviously, we talked about this with Pat Roach months ago on your show. It's come up a couple of times since then, but you can't argue with the numbers. Deliveries increased 8%. Their new orders increased 37%. They're sitting on a backlog of orders totaling $10 billion in revenue. Continuing to see builders offering buy downs to incentivize buyers was something that they mentioned as being a strength for them. So, we'll continue to see what happens here. Obviously, the sales on existing homes have dropped, so they're kind of filling the gap here in the new build market. So stock's flat.
Yeah, Lennar is it's a cool play. This is one that we added. Buffett added it to his portfolio. Now, I will say the order of that decision was Buffett added it and then we added it. So Buffett did not steal our idea. I just want to make that clear. But I have always liked the idea of home builders. It's very, very cyclical, right? You will have times where you make a lot of money, you lose a lot of money, or you do nothing for a while. Obviously, in December of 2021, the stock traded basically where it's at today at 116. You bought it there. You saw it ride down to 64, got absolutely hammered, bloodbath. But you know what? Now, I totally get the story. You've got structurally underbuilt housing in the U.S., got a lot of people looking for homes. It's been really tough for millennials to buy a house, and these are sort of like your starter homes or even higher, like kind of mid-luxury. Yeah, I've got a friend who actually used to work for these guys, used to talk very well about them, still does. Great company. I kind of like the story long term. We've got a very small position in our portfolio on it. We'll see what happens.
Yeah, I was just reading here too, Buffett's still bullish on it seems like, and people are kind of using it as a proxy for the strength of the U.S. housing market. So we'll see what happens. Let's cover a fun meme stock here. GameStop missed on the top line by 10%. Revenue is only up 2.5%. Maybe this is the going to zero. Maybe we have two this episode. They still weren't profitable this quarter. Net loss of $2.8 million, which the only thing positive about that is if you look at last year, they were down $108 million on the quarter. So, they're making a movie called Dumb Money. People are trying to get behind this. Oh, meme stocks, they stuck it to the hedge funds. Maybe it'll be a good movie. I don't know. Are you gonna watch it?
I saw the trailer. It's okay. I don't know. I don't know. I'm not qualified to talk about this because I'm not a gamer. I'm terrible at video games. Other than when we were in college, we played GTA, and when that thing came out, I don't think we left our dorm room for a week. It was unbelievable. And you know what? I have an Xbox still. I would get the new Xbox, which I haven't touched my Xbox in probably 5 years. However, if there's a new GTA that comes out, I may go out and buy a new Xbox because that was unbelievable. I don't know. Are people going to GameStop? Really? Do you have to go to GameStop to buy a game anymore? I don't know.
No. So I have a little bit more experience with it. I will say it's really fallen off since joining over here. I don't know, what the correlation is. Maybe somebody's working me really hard. It's just speculation, purely speculation.
Or
that
you
being
grew
said,
up.
Yeah, well, I have 2 kids now, but
You're not a 10-year-old anymore.
Yes, for a little while now, I will say Formula One. I love Formula One. And that is my brother who does not live around here. That's usually what I was playing with him, staying in touch. Anyways, we're not going to talk about the video games I do or do not play any longer. What I will say is this. Everything is you can just buy it all online. I could go on my phone right now, say, oh yeah, buy this game and download it on I was a PlayStation person, download it on my PlayStation 5, and it would be ready when I got home.
Right. So
you don't need to go buy it anymore.
Yeah, because don't you just download it? It's all cloud based through Xbox, right?
Yeah, it's all on there, and the cost of playing online now has just continued to skyrocket, right. And part of it's paying for the cloud and the storage for all your stuff, and so. Yeah, I mean, nobody goes to physical stores anymore. I haven't gone to a physical GameStop in forever. Even when I was a broke college student, it was like, well, just wait till it goes on sale online. You don't even have to go to the store to, buy it when they're trying to offload a physical game.
Right.
So
what was the meme stock thing? I followed that a little bit, but GameStop, AMC. What was the whole thing there? It was like a short squeeze, and they were trying to stick it to the man. And holy cow, AMC traded for $8, $8.25, somewhere in there, went up to about 230. Wow,
dude, GameStop was up 1,700%. It went from $4.42 a share to 80, I believe. 81. I mean, in the matter of I can't even. It's so small on Yahoo, like where I'm looking at it right now. I can barely pinpoint it. In less than a month, it went up 1,800%. And guess who made all the money? The guys who front ran it.
And it's called Dumb Money? Is that what it's called?
Yeah, Dumb Money.
This is a headline from Slate. Dumb Money nails the rich idiots of Wall Street. The GameStop movie resorts to some David versus Goliath cliches. At least it has Goliath's number. Interesting. Okay. Yeah, basically just stick it to the man. Looks like some people might have gotten stuck with the stock. So I don't know. I never bought it. I wish I would have. Wish I would have bought it for $1 and sold it at, what did it get to? 81. Wow. All right. Well, I guess I missed that one.
That's not one that would be going in client portfolios if I had to take a guess on what you would say about that. Okay. Let's talk Smith and Wesson here to close it out. Beat across the board. Revenue was up 35%. I know earnings per share was basically flat. CFO Deanna McPherson was very upbeat on the results. They had a strong quarter. Obviously, they've been fighting inflation like everybody else, but have done a good job managing their inventories and increasing cash from operations. So that's up almost 80% for them. Fall is actually usually their busy season, so already having some really strong top-line growth going into the fall has them feeling very good. Stock's up 6.5%.
This is one where if you buy it, obviously controversial. Some people don't want to own this thing. I get it. But, if you own it every 4 years, you can make a boatload of money. I mean, look at that stock chart. So 04 trades for $1 a share. It goes up to $16.50 by October of 07, right before the presidential election. Then it plummets back down to 2 in 08. A little bit of a rally into 2016. I'm sorry, massive rally into 2016. It goes from about 7.5 a share to 23. Completely gets wiped out in 2019. And then in the next election cycle, 2020, it goes up to a quick peak in the 30s from 5. And now it's back down to that kind of lower level. It got into the $8 range in 2022. So if you're a chart person, it's like every 4 years, right around the election, makes sense. It absolutely takes off, pays a 4% dividend. I'm not buying it personally or for the portfolio client portfolios, but certainly some trend lines there for sure.
If we're talking firearms, is there anything else that we want to discuss, or should we end it there for the day?
That might be all I got on that one. Didn't you had a story you wanted to talk about, or there was something else, inflation related?
No. Well, I think so. Next week, earnings kind of died down. We've covered a lot as of the beginning of September. We'd basically gotten through 99% of S&P earnings. So next week there's not a whole lot going on, or there hasn't been a whole lot going on. So figure we can kind of summarize and then talk about some interesting stories. I know there were some comments from Jamie Dimon about centralized banking. That was interesting. We could always talk about. There were some inflation stories. The Fed obviously has their meeting middle of next week, and we'll be announcing what they're doing moving forward. So I figure we can just kind of cover some of that stuff.
Yeah, we've got a little lull in earnings, and then Q3 starts up pretty soon. We've got some big names coming up. I'm excited.
Yeah, so am I. So we'll close it out there. Thank you, everybody, for listening in. Remember, if you like the show, please like, subscribe, share with your friends. Already talked about what we'll be covering kind of next week, just a good summarization of what happened in this previous quarter. If you'd like to learn more about Stenger Family Office, visit the website. Give us a call at 630-912-8431 to request a complimentary starter kit. You can start a relationship with us with just $1,000 starter account. 2 events now coming up next week. Our Houston folks up in Spring celebrating the opening of our office down there. Happy hour on September 20th. That's Wednesday. If you're in that area, we would love to see you. Bring your friends, bring your family. November 14th and 15th, we're going to have our annual Investor Day again, Hotel Indigo here in Naperville. So we appreciate you listening again and hope you have a wonderful weekend.